Hi guys, so we are down to our final two lessons on finance. The one that's going to drop on Tuesday and then what's going to drop on Thursday. And then next week, that's pretty much it. Um, so yeah, just bear with me for this 1 week and I think I got everything out to you that I wanted to get out. So, if you notice the lessons, I've tried to give you less work now that we're winding down. So just like last time, the format's going to be similar where I'm going to do a tutorial video, and then you'll watch a second tutorial video, and then you'll just read the chapter from Finessin, and then just answer the one question. Okay, so let's get started. So today we're talking about credit scores. This number, these numbers right here. And when you become an adult, this number is going to become extremely important for your life because this kind of opens the door for all types of things. So the question is, well, what is a credit score? Or credit, what we call credit worthiness. So credit worthiness, okay, think of it this way, is basically your worthiness to be lent money. Or in other words, what's the probability you will repay loans? It's like, think of it this way. If your friend comes up to you and says, hey Alyssa, can I borrow 60 bucks? Some of the thoughts that are going to go through your head is, okay, this friend, do they usually pay people back? Does this person have a job? If they don't have a job, how are they going to get 60 bucks to pay me back? The point is, you go through these like series of questions in your head to let you know is how risky is it to lend to you? So in other words, that friend who asked you for money, if that friend has a history of not paying things back, not earning any money, that's probably not somebody you want to lend money to. But then if you have a friend who, for example, asks to borrow money from you and pay, let's say they borrow $20 from you and then they pay you back 25, I mean, that is a person you're going to lend money to, most likely, because they're trustworthy. They're what we call credit worthy. All right? So if we go back to these numbers, and the numbers are self-explanatory. So a credit score basically ranges from 300, which is the lowest, to 850, which is the highest. And what's judged bad, fair, good, excellent, that could depend on the bank. But for the most part, these are the ranges. So yeah, if you have a score between 300 and 629, you have very bad credit, which means you're very high risk. If you have 630 to 689, then you would be considered fair, meaning you're risky, but you're not in the red, so to speak. And most likely, it will be very hard for you to get loans, even in fair. If you have 690 to 719, you would consider to have a good score. On average, most Americans kind of fall within this realm, which means, yeah, you're considered credit worthy and you could likely get loans, but, chances are the interest rates you get will probably be a little on the high side. And then for excellent credit, if you have a score of 720 to 850, then yeah, it means you have a solid history of paying loans back. In other words, banks would see you as very trustworthy to lend money to. There's a catch though, and I'll talk about that in the next video. But that's basically the way the scores work. So again, 300 to 629, very bad. You're considered high risk. It will be very hard for you to get credit cards. It will be hard for you to get loans, like a car loan or a mortgage for a house. Fair, it doesn't mean you won't get loans, but what happens is they might give you a loan at a higher interest rate, meaning when you borrow from a bank or any lender, they are just going to charge you more money to pay them back. And then good, excellent, again, why does this matter? Yeah, you could hear the fireworks. Brooklyn's in the house. It's like going on every night. Makes it very hard for filming. Anyway, yeah, if you have a score that's good to excellent, then you are more likely to get loans and you're more likely to get better interest rates. So then the question is, well, how do they figure out these numbers? Okay, and this is where it gets kind of tricky. So let's go back to our notes. Okay, so this is how they determine those numbers, okay? Think of a pie chart, okay? And I'm just going to make my lines here. Then we're going to do one. Okay, so this is kind of the breakdown. 35% of your score comes from your payment history. In other words, do you pay your bills? Do you pay your credit cards? Do you pay your loans on time every time? If you do that, it helps your score a lot. Then 30% comes from the amount of money owed. So in other words, if you owe very little, it's an inverse relationship, meaning if you owe very little, it's going to actually increase your score. And on the flip side, if you owe a lot, it's going to lower your score. Okay, so this is big. It's I'll explain more about this, especially next week, and maybe I'll mention it again a little later. But that's kind of how it works. In other words, again, the more you owe, the lower your score goes. The less you owe, the higher your score goes. Then 15% of your score comes from what's called the length of your credit history. Meaning, if like a lot of my credit cards, I took out back in 2006. So I've had those credit cards for 14 years. So in other words, with each year that I have those credit cards, the longer it gets, sorry guys. Okay, meaning the longer that I own that credit, the higher my score goes. Likewise, and this is 10%, if let's say I was to get a brand new credit card tomorrow, that would actually lower my score. Okay, because again, notice how new credit is 10%, but if it's new, then it's going to shorten the length of credit history that you have. So like I said, it's credit credit scores are always changing, all right, depending on what you do. And then the final 10% is the types of credit. Now again, I'll go over this in detail on Thursday, but just to give you the quick overview, there's two types of credit. There's what's called revolving credit and installment credit. So, revolving credit. What makes it revolving credit? Well, what revolving credit is it's renewed as the debt is paid. Meaning, think of what a revolving door is, right? If you just keep walking around in the door, you're just going to keep spinning in circles. So that's kind of like what a credit card is. Like I said, I'll go in this detail on Thursday. But with a credit card, I can make a payment for this month. Like let's say I make $500 $500 payment. that goes back into my credit, and I could spend that money again. So the reason why people fall into credit card debt so easily is because they can keep spending on their credit card even after they pay it. So it's like a revolving door, hence revolving credit. Installment debt is basically a fixed, scheduled payment until the debt is paid off. So installment credit would be like a car loan, right? When you get, let's say you want to buy a car and the car is $30,000 and you only have $5,000 cash, so you get a loan for $25,000 from a bank. Now, once you get that $25,000 loan and you're making payments on it, you can't ask for more money. So in other words, every time you make a payment, that $25,000 is going to keep getting lower and lower and lower until it gets to zero when you pay it off. That's what installment debt is. So like car loans, student loans, mortgages. Again, the point is once you take out the loan, you're just getting that balance to zero. You can't put more money on it. Whereas again, with revolving debt, a credit card, I can make a payment and then just swipe the card. I can make another payment and swipe the card again, and that's why it's so difficult to get out of it. So again, this is what makes up your credit score. Payment history and amount owed make up the largest chunks of it. And then, of course, length of credit history, new credit, types of credit, they affect it to some degree, but again, these two are going to be the biggest chunks, all right? And that's how you get these numbers right here. And like I said, they're always kind of fluctuating. So for example, last month I had, I think, a score of 7, well, at the beginning of the year, before I started teaching you guys, I had a score of 815, which was amazing. And then after teaching and using my credit card to buy tons of school supplies and things like that, all of a sudden my score has now dropped to 707. It's just been declining each month. Now, when it was at 815, I was getting a lot of offers from credit card companies. I was getting a lot of offers for balance transfers and things like that. Once my score dropped to 707, all of a sudden I'm not getting any offers whatsoever. So it just goes to show the lower your score gets, doors kind of close for you a little bit. On the flip side, I know people who had very high scores. In fact, I had a friend who had an 840, and he went to apply for a loan, and the bank actually denied him. Now, the weird thing about that was, because, wait a minute, I have a good score. The weird thing was the bank basically saw it as, you're too good at paying back money. Meaning the bank saw it as, we don't want to lend you money because you're going to pay it back to us so quickly, we're not going to make money off of you. So the irony of having a high score sometimes is that banks can still possibly deny you, like it has happened. So, you know, like I said, that's the tricky thing with credit scores, is the numbers always change depending on how often you use your cards, how much debt you have. They go up, it goes down. But the point is you always want to live within this range here. Right now you guys don't have credit scores because you shouldn't have a credit card yet. You don't have any loans or anything like that, so you don't have a credit history. You don't have a history of paying things back. But once you go to college, maybe take out student loans, maybe you'll get your first credit card, this is when you'll start building credit history. So I'm going to end this video here, and there should be one more quick video after this, and then get you to the reading. So I'll see you guys in a few minutes.